Welcome to The Explainer. I am so genuinely thrilled you're joining us today because we're focusing on what is literally one of the most highly anticipated, talked about financial events in recent memory, the SpaceX IPO. It's the moment the whole world's been waiting for, right? The doors are finally opening to the public, but today we're going to do things a little bit differently. We're going to look past the countdown clocks, way past the launchpad excitement, and we are going to strictly do the math on the hype. Because look, the question almost everyone is asking right now is SpaceX a great company? And honestly, the answer to that is an obvious yes. But I want to completely reframe our mindset right here, right now. The question that actually decides whether we make money is this: is SpaceX a great investment at today's price? Now, those two questions might feel identical, but they are absolutely not. The entire distance between admiring a genuinely remarkable company and making a smart financial investment, well, that's exactly where ordinary investors quietly lose their money. So, let's dive into this. Let's look at the actual history of how these heavily hyped days play out. Take two recent massive IPOs as an example. A few years ago, Rivian went public to enormous, off-the-charts excitement. The stock popped more than 20% on day one. Everyone thought they were early, right? But over the next year, it fell roughly 67%. Then look at Reddit. It went public, looked kind of soft out of the gate, almost disappointing, and then it climbed nearly 150%. It's the exact same market with completely opposite outcomes. The takeaway here is super simple. A big green number on the first day of trading tells you absolutely nothing about the long-term reality of the investment. We have to look deeper.
Which brings us to Section 1, Under the SpaceX Hood. Let's talk financial fundamentals.
To do that, we need to move past the rockets and look at the actual business itself. When you picture SpaceX, you naturally picture rockets, right? But breaking down their reported $18.7 billion in total revenue last year reveals a totally different story. The rockets aren't actually the primary engine anymore. Starlink, their satellite internet service, brought in roughly $11.4 billion. That is a massive 61% of everything the company makes.
But let's build on that revenue picture for a second, because top-line revenue is definitely not the same as profit. Look at this reality check. Yes, total revenue was a genuinely massive $18.7 billion, but the overall company didn't actually make a profit last year. It actually lost somewhere around $4.9 billion. Turns out, shooting metal tubes into space is, well, quite expensive. But the really fascinating part? Starlink generated around $4.4 billion in operating income. So the entire operation is relying almost exclusively on Starlink just to make real money.
Think about it this way. When you buy a share of SpaceX right now, this is what you're really buying. It's essentially one highly profitable engine dragging several heavier, money-losing cars. It's a really vivid way to illustrate how the incredibly profitable Starlink engine is currently burdened by the cash-burning launch divisions and all those newer, flashier bets. Someday those other cars might become incredibly valuable, but someday is doing a whole lot of heavy lifting for the current bottom line.
And that leads us right into Section 2, the price tag reality, valuation versus business. That someday brings us to the massive number completely dominating the headlines, a price tag written as if that someday has already securely arrived. Let's trace exactly how this happened. I like to call this the valuation sprint. Just 11 months ago, in the private market, SpaceX was valued at around $400 billion. Now, fast forward to this IPO debut, it's hitting the public market at an astonishing $1.75 trillion valuation. That is more than 4 times higher in less than a year. So you have to ask, did the underlying business quadruple in 11 months? Did they magically build 4 times as many rockets or satellites overnight? No way. Revenue grew by maybe a third. What skyrocketed wasn't the company itself. It was the story being told about the company right before the public was finally invited in.
To really put that price tag into perspective, we need to talk about the number 94. At a $1.75 trillion valuation against their current sales, investors are paying an extreme $94 for every single dollar of revenue this business produces. I mean, that's the financial equivalent of paying for a century's worth of coffee up front before you've even taken a single sip. And remember, this is an overall money-losing business right now. Most established, genuinely profitable companies trade in the low single to low double digits on this exact measure. 94 to 1 is just staggering.
Now, what's incredibly interesting about this is how completely detached that IPO price is from both independent research and the company's own profitable parts. The IPO price is $1.75 trillion. But an independent Wall Street research firm ran the numbers and estimated the value much closer to $780 billion, which is less than half. And if you take Starlink, the only part actually making money, and value it incredibly generously at 40 times its earnings, you get a $176 billion business. Basically, the rest of that $1.75 trillion price tag is being handed to you as a massive bet on things that haven't even happened yet.
All right, let's move to Section 3, the IPO relay race. Let's look at how markets actually operate. So if the price is already that stretched, why does it keep climbing the exact moment trading opens? Well, to understand that, we need to peek behind the curtain. The absolute key here is realizing that an IPO is not just one giant crowd buying at one price. It's actually a relay race, and retail investors, we're the final runner. Here's how it works. Step 1, big banks and insiders lock in the cheap shares quietly before trading even opens. Step 2, public trading opens, and massive demand from everyone who couldn't get in at the starting line drives the price way, way up. And step 3, who do you think is waiting to sell those shares at the new inflated price? The insiders. They pass the risk baton to retail buyers at a massive premium. So that opening day pop you hear everyone cheering about on TV, it isn't proof of a great stock. Mechanically, it's just the sound of risk changing hands.
Now for Section 4, the lockup period trap. This is the hidden supply danger.
This whole dynamic builds into an even bigger risk for the everyday investor, a hidden supply danger that catches people totally off guard months after the initial IPO hype finally fades away. If you aren't familiar with the term, a lockup period is a time frame, often around 6 months, that completely restricts insiders from selling their shares right away. Think of it like a massive dam holding back stock supply. The reason for it is super simple. If everyone holding cheap shares dumped them on day one, the price would instantly collapse. But here's the catch. That water doesn't disappear. It just waits.
And when that dam finally lifts, history shows us exactly what happens. When Uber's lockup expired, the stock hit an all-time low on that exact day. Rivian dropped sharply in one single session. Palantir fell double digits. The historical pattern here is remarkably clean. Fresh supply meets tired demand, and the price drops. And the higher the speculative premium at the start, which SpaceX definitely absolutely has, the harder the stock tends to fall when that insider supply finally floods the open market.
Let's move into Section 5, the miracle math. Time to calculate the bet.
This brings us to the absolute most important part of our entire analysis today. We really need to calculate what SpaceX actually has to achieve over the next decade to make paying this massive $1.75 trillion price mathematically worth your while. And we're going to set the bar as low as we honestly can. We aren't even asking to get rich here. We're literally just asking what it takes to break even against the lazy alternative of buying a plain 10% index fund and doing absolutely nothing. To just match that basic 10% benchmark over a decade, starting at today's price, SpaceX would need to reach a valuation of roughly $4.5 trillion 10 years from now.
And this brilliantly illustrates the problem. Assuming very generous profit multiples 10 years from now, to justify a $4.5 trillion valuation, the company needs to pull in somewhere around $560 billion in revenue. Remember, they're at $18.7 billion today, and they need $560 billion in a decade. That is an absurd 30 times growth requirement just to tie a basic index fund. It really shows the sheer uphill battle the current valuation creates for new investors. Just think about the sheer scale of that growth requirement for a second. To pull that off, SpaceX would have to grow its revenue by approximately 40% every single year for 10 straight years without a single stumble. Almost no company in human history at this scale has ever done that. By buying at today's IPO price, you aren't buying a great company at a fair price. You're paying up front for a near-miracle outcome. And the kicker, you only collect a boring average return if that miracle flawlessly shows up.
Finally, Section 6, the smarter investment path, choosing patience and reality.
So, what does this all mean? Where does that leave us? Well, just because the price is steep doesn't mean you have to completely ignore this remarkable company. Based on everything we've looked at today, you really have 3 paths here. Path 1, chase the hype on day 1. But as we've just mathematically shown, that's probably the weakest seat in the house. Path 2, write the company off forever on principle because the initial price was ugly. But honestly, that throws away a genuinely great business unnecessarily. So what about path 3? Be patient and let reality settle the price. This path costs you absolutely nothing but patience. You let the forced buying finish, you let those lockup periods wash through, and you let the price settle at a level that reflects the actual business instead of the sheer excitement.
Always, always remember this. The market rewards the patient far more reliably than it rewards the early. The best companies of the last few decades stayed great for years. You literally do not need to own them on day 1 to do extraordinarily well. If SpaceX is truly a generational company, it'll still be sitting right there next quarter, and the quarter after that, at a price set by reality instead of a countdown clock.
So as you watch the news and see the opening bells ringing for this historic IPO, I want to leave you with one final provocative thought before you make your next move. Ask yourself, are you buying a business or are you just paying for a story? Thank you so much for joining me on The Explainer today. Always remember to do the math, stay patient, and I'll see you next time.